Imagine waking up on a Monday morning, and as soon as your paycheck hits your account, it immediately distributes funds without you lifting a finger. A portion flows into your savings, another chunk is invested in your favorite sustainable fund, and just enough is allocated for this month's bills. This is not a distant fantasy, but a glimpse into the world of programmable money. At its essence, programmable money refers to digital currency that can be programmed with specific rules and conditions, allowing for automated transactions and financial management. Think of it as a digital wallet that obeys your personalized financial commands, executing them seamlessly in the background. The beauty of this system lies in its increased flexibility. No longer bound by traditional banking hours or the limitations of manual budgeting, individuals can enjoy a level of financial autonomy previously unimaginable. Suppose you could set up your financial life to run on autopilot. Your salary could be divided according to your personal priorities, each transaction executed to align with your goals. In this scenario, budgeting becomes less of a chore and more of a preset program, freeing your time for what truly matters. But what are the broader implications of this shift? With programmable money, the automation of budgeting and spending could lead to more disciplined financial behaviors. Envision a world where individuals are less likely to overspend because their money is already earmarked for specific purposes. However, this convenience comes with questions. Who controls the programming? What happens if those rules misalign with an individual's changing circumstances? The strange consequence is that while programmable money could enhance personal finance, it could also lock individuals into rigid financial frameworks, if not designed thoughtfully. As we ponder these possibilities, we begin to appreciate the potential of programmable money to not only transform individual lives, but also to reshape the very fabric of our economic interactions. What would happen if every transaction we made was not just a simple exchange, but a part of a larger, intelligently designed financial ecosystem? What if buying a house could be as simple as sending a digital token? Imagine a world where the complexities of real estate transactions are stripped away, leaving behind a streamlined process governed by smart contracts. Picture this. You find your dream home, and instead of navigating a maze of paperwork, waiting for approvals, and incurring hefty fees for agents, you simply engage a smart contract on a decentralized platform. This contract is a set of self-executing code that automatically manages the transaction according to predefined conditions. You, the buyer, and the seller agree on the terms, and the smart contract takes it from there, ensuring that the title transfers only when the payment is confirmed. The beauty of this technology lies in its ability to automate and enforce agreements without the need for intermediaries like banks or real estate agents, who often complicate the process. Now, let's delve into how this works. Smart contracts operate on blockchain technology, which is essentially a distributed ledger that records transactions securely and transparently. When you initiate a transaction, the smart contract verifies your payment and the seller's title ownership, executing the transfer of ownership seamlessly. This eliminates the risk of fraud, as the terms are coded and immutable. Once it's set, it cannot be altered without consensus. Imagine not worrying about hidden fees or last-minute changes that can derail a deal. The strange consequence is that this not only simplifies the buying process, but also democratizes access to real estate, making it more affordable and transparent. However, what happens if we take this premise seriously? Who benefits? Well, first-time homebuyers could find themselves in a more equitable position, free from the traditional gatekeeping of the real estate market. But there are also trade-offs. If smart contracts become the norm, what happens to the roles of real estate professionals? Will they adapt, or will their expertise become obsolete? The balance between customization and decentralization is a delicate one. While some may relish the control that smart contracts offer, others might feel overwhelmed by the responsibility of navigating these digital landscapes without traditional guidance. As we explore the implications of this technology, we must ask, how can we ensure that the benefits of automation don't come at the cost of accessibility? Can we design these systems to empower rather than exclude? The answers will shape the future of our financial systems and fundamentally alter our interactions with money and property. Imagine a world where the concept of credit is transformed by decentralized lending platforms. Picture a scenario where individuals seeking loans can bypass traditional banks entirely. instead turning to a network of peers who are willing to lend based on smart contracts. What if you could borrow money without a lengthy application process, credit checks, or high interest rates? You simply enter a decentralized platform, outline your needs, and potential lenders assess your proposal based on criteria defined by programmable rules. This might include factors like your transaction history on the blockchain or even your social reputation in a decentralized network. The strange consequence is that credit becomes not just a privilege for the few, but a possibility for many who have been historically excluded from traditional financial systems. Let's explore how decentralized finance, or DeFi, is reshaping familiar financial practices. In a conventional banking system, the middleman, the bank, holds all the power, dictating terms and fees while often making it difficult for individuals to access capital. In contrast, DeFi platforms put the power back into the hands of users, allowing for a more fluid and transparent process. Imagine a small business owner needing a quick influx of cash to seize an opportunity. Instead of waiting weeks for bank approvals, they could present their case on a decentralized lending platform where smart contracts automatically execute once the agreed terms are met, releasing funds directly to them. This not only speeds up transactions, but also reduces costs significantly. Now consider the implications of this shift. On one hand, it opens the door to financial accessibility for underserved populations, potentially democratizing finance in unprecedented ways. However, it raises pressing questions about risk and accountability. Without traditional banks, who is responsible if a loan goes unpaid? The decentralized nature of these systems means that users must navigate their own due diligence, weighing the risks of lending to someone they may never meet. How do we ensure that these systems are not hijacked by those with malicious intent? Moreover, as we reflect on the benefits of programmable money, we must also consider the balance between customization and decentralization. While tailored financial solutions may empower individuals, they can also lead to fragmentation. What happens when the rules set by one platform conflict with those of another? Can we create a cohesive financial ecosystem, or will we see a patchwork of isolated systems that complicate rather than simplify our financial interactions? As we explore these innovative alternatives to traditional banking, we are left to ponder, how might our understanding of credit, loans, and financial trust evolve in a world where programmable money is the norm? The answers lie not just in technology, but in the values we choose to embed within these systems. What if everyone had access to financial services, regardless of their location? Imagine a remote village, nestled in the mountains, where traditional banks are but a distant memory. In this world, financial services are not reserved for urban centers with sprawling bank branches, but rather they flow seamlessly through decentralized platforms. Picture the villagers, farmers, artisans, and entrepreneurs, each equipped with a smartphone, their gateway to a global economy. With decentralized finance, or DeFi, they can access loans, savings, and investment opportunities that were previously unattainable. Consider the story of a small farmer named Anya. Anya dreams of expanding her organic farm, but conventional banks have turned her away, citing her lack of credit history and collateral. Yet, through a decentralized lending platform, she can present her farming proposal directly to a network of potential lenders. Smart contracts automate the terms of her loan, ensuring that both parties are protected without the need for a middleman. This system not only empowers Anya, but also connects her to a broader community of lenders who believe in her vision. The promise of financial inclusion through decentralization is profound. It opens doors for underserved populations, enabling them to participate in economic activities that were once beyond their reach. Women in developing regions, for instance, often face barriers to accessing capital. Yet through decentralized platforms, they can establish creditworthiness based on their transaction history rather than traditional metrics. This shift not only benefits individuals, but can uplift entire communities, fostering entrepreneurship and innovation. However, as we marvel at these possibilities, we must also confront the challenges that accompany this transformation. What happens when the systems designed to include everyone inadvertently exclude those without the necessary technological literacy or access to the internet? The strange consequence is that while decentralization has the potential to democratize finance, it could also deepen existing divides if not approached thoughtfully. So as we ponder the implications of decentralizing financial systems, we must ask ourselves, how can we ensure that the benefits of accessibility and empowerment reach the most marginalized? What safeguards can we implement to prevent a new form of exclusion? The answers to these questions will determine whether the promise of financial inclusion through decentralized systems becomes a reality or remains a distant dream. Imagine a bustling marketplace where merchants and customers interact freely, each transaction unfolding without the heavy hand of intermediaries. Now, suppose that this vibrant scene is governed not by the familiar rules of banks and regulations, but by a decentralized network of smart contracts, each one self-executing and transparent. What would happen when such innovative financial systems collide with outdated regulations? Picture a small business that thrives on a decentralized finance platform, providing loans and services tailored to individual needs. Yet, when it attempts to operate across borders, it faces a labyrinth of regulatory hurdles designed for a bygone era. These regulations, crafted in a time when centralized systems ruled, can stifle the creativity and growth potential of these new financial models. The strange consequence is that while these decentralized systems promise inclusion and innovation, they often find themselves shackled by the very frameworks that were meant to protect consumers. Imagine a scenario where a tech-savvy entrepreneur creates a groundbreaking app that allows users to lend and borrow directly from one another, bypassing traditional banking altogether. The app gains traction, users flock to it, and it seems poised to revolutionize personal finance. But then, it faces scrutiny from regulators who are concerned about consumer protection, data privacy, and potential money laundering. Suddenly, instead of fostering innovation, the regulatory landscape becomes an obstacle course, forcing the entrepreneur to divert resources from development to compliance. This tension between innovation and regulation raises critical questions. How do we safeguard consumers without stifling innovation? What if the very rules intended to protect us end up hampering the evolution of financial systems that could democratize access? The regulatory landscape becomes a double-edged sword, capable of both nurturing and suffocating progress. Now consider this. What if regulators were to engage directly with innovators, creating a collaborative environment where regulations evolve alongside technological advancements? Imagine a scenario where pilot programs are established, allowing decentralized systems to operate under a temporary regulatory framework, providing insights that could inform future regulations. In this way, innovation could flourish without the constant shadow of punitive measures looming overhead. As we navigate these complexities, we must ponder the implications of a regulatory approach that embraces innovation rather than fears it. Who benefits from a system that adapts to the future rather than clinging to the past? What trade-offs must we accept to ensure that the potential of decentralized finance is fully realized? This thought experiment challenges us to envision a world where regulations and innovations coexist, fostering a financial landscape that is both secure and liberating, one that empowers individuals while preserving the integrity of the system. The answers, as we will explore, may reshape our understanding of finance itself. Imagine waking up in a world where your financial decisions are not just guided by instinct or past experiences, but are seamlessly integrated into your daily life through programmable money. Picture this. As your alarm goes off, your smart financial assistant automatically assesses your monthly budget based on your spending patterns and upcoming obligations. Without your input, it allocates funds for bills, savings, and even a spontaneous dinner out with friends. How does that change your approach to money? Instead of worrying about whether you can afford a night out, you simply decide where to go. Your programmable money ensures that you stay within your budget while still enjoying life's pleasures. Now, let's take a walk through your day. You decide to grab coffee at your favorite cafe. As you order, your app nudges you with a reminder that today is a discount day for your usual order, thanks to a loyalty program coded into your spending preferences. When you pay, the transaction is instant, and the cafe receives their payment almost immediately, thanks to smart contracts that eliminate delays and fees. This efficiency not only enhances your experience, but also supports small businesses by ensuring they can access their funds without waiting for processing times. But it is not just about convenience, it's about empowerment. Consider how your programmable money adapts to your values. Suppose you are passionate about sustainability. Your financial system can be programmed to prioritize purchases from eco-friendly businesses or allocate a portion of your income to environmental causes automatically. Each transaction becomes a reflection of your beliefs and priorities, shaping the economy around you in ways that align with your values. What would happen if everyone could direct their money toward causes they care about, fostering a collective shift in market behavior? Yet this new landscape poses intriguing questions. With automation comes a risk, the potential loss of personal agency. If your financial decisions are largely made by algorithms, how do you maintain control? Imagine a scenario where your assistant optimizes your spending so effectively that you find yourself on a preset path with little room for spontaneity or change. Would you feel comfortable letting an algorithm dictate your financial choices? What if the parameters it follows do not account for life's unpredictability? Additionally, think about the implications for personal finance management. With programmable money, budgeting becomes less of a chore and more of an automated process. But this also means that individuals may need to develop new skills, like understanding the algorithms that govern their finances, to ensure they are not left at the mercy of a system they do not fully understand. What balance can be struck between convenience and personal responsibility? As your day unfolds, you realize that every single financial interaction, from buying groceries to investing in your future, is influenced by this programmable framework. You can enjoy a life where your money works for you, optimizing your choices and reflecting your values. But amidst this convenience, we must remain vigilant about the trade-offs. In this brave new world of programmable money, the question lingers: how do we design these systems to empower individuals without stripping away their financial autonomy? The answers are not just technical, they are deeply personal and societal, shaping the future of our economic landscape.